Welcome to OpenPay's FY20 full-year results investor briefing. My name is Jane Lowe and I'm the Managing Director of IR Department. It's a pleasure to have supported OpenPay on investor relations across what has been a very strong period of growth. And it's also my pleasure to host this briefing today for OpenPay's first full-year result as a listed company following the company's December 2019 IPO. Presenting today will be CEO and Managing Director Michael Idle and CFO Andrew Burns. Michael and Andrew will present from the presentation that was lodged with the ASX this morning and is also available via the OpenPay website. The formal presentation will be followed by a Q&A session. If you'd like to ask a question, you can do so at any time by entering your question into the Q&A function below. We will get through as many of the questions that you put forward in the time that we have. I'd now like to hand over to CEO Michael Idle. Thank you, Michael.
Thank you, Jane, and good morning, everyone. Thank you for making time to attend today's annual results presentation. In my update, I will comment on three aspects of this financial year results. First, a strategic wrap-up of our first year as a listed company. Second, our business performance along our key metrics. And third, following Andrew's presentation, OpenPay's upcoming strategic priorities and what you can expect from us in FY21. We will focus on some key slides of the investor presentation and announce them separately. So starting with page 6, I'd like to commence with a wrap-up of the year and how we have delivered on our FY20 strategy. First of all, FY20 has been a year of exceptional challenges, but also some extraordinary achievements. We have been able to significantly grow our Buy Now, Pay Smarter business in our home market across all industry verticals we are focusing on: healthcare, home improvement, automotive and retail, despite the challenges and uncertainties due to the various COVID-19 lockdowns. As well as a significant number of new merchant agreements and launches, we have been able to enter some long-term or even exclusive deals with integration partners like Pentana in automotive, MyHealth1st in healthcare, and more recently, MSL Solutions for Gold memberships. They all provide us access to strong merchant networks and customer bases to proliferate our product at scale into lifestyle areas where our customers want to use us. We also successfully launched our business in the UK with notable merchant wins like JD Sports and more recently with the Hut Group, with a clearly differentiated longer-term product, which gives us a strong competitive edge in the UK's contested retail space. Our rapidly rising profile and growing customer base has significantly improved our position to win further enterprise merchant deals and will lead the way to launching in our other verticals over time in that market. With the IPO in December 2019 and the highly oversubscribed capital raise in June 2020, not only have we been able to bring reputable investors onto our register, but we have strengthened our balance sheet with available cash of $70.1 million as at financial year end. In addition to our strong debt facilities of $45 million in Australia, we also secured our first UK debt facility of £25 million in June, with the opportunity to extend to £60 million. Both give us an excellent runway to further grow the business and invest in technology and talent over the year ahead. And then on the right, we are very proud of our first significant innovation via our B2B product, OpenPay for Business. OpenPay for Business is an end-to-end business account management and payment platform that provides fast business customer onboarding, customizable account management features, invoicing, and automated reconciliation. I will discuss this in more detail later on. And to the very right, and finally, we have demonstrated our responsible and responsive approach to our business and customer needs, particularly in Q3 and Q4 through COVID-19. These initiatives have greatly helped us to strike the right balance between supporting our merchants and customers, protecting the company by preserving cash, and keeping our staff safe and healthy. This leads me to the second part of my presentation about our excellent business performance in FY20. Please turn over to page 7. Our leading indicators have grown significantly year on year. Active plans are up by 229% and active customers by 141%. These growth rates have been above our expectations. To put them into perspective, during the financial year, the percentage of repeat customers grew to 70%, and already 42% of our customers currently have multiple congruent plans with us. This is very encouraging, as customers are making it a routine to use OpenPay for life's important purchases and to smoothen cash flows along their pay cycle. Our customers are also very receptive to direct marketing for promotions which we offer in joint campaigns with our merchant partners across multiple industries. The number of active merchants has grown by 52%, which is remarkable as we have put a strong focus on larger merchants and integration partners to scale more quickly. And we have achieved this strong result despite some of the integration delays we have seen on the merchant side due to COVID-19, particularly for in-store. Merchant onboarding has been accelerating again more recently in areas where restrictions have been loosened, and this will provide us with a strong growth trajectory into FY21. This growth in leading indicators has translated into 98% growth in our total transaction value, up to $192.8 million, and a revenue increase of 64% to $80 million for the financial year. Looking at these two metrics in combination, we have achieved a strong 9.3% gross revenue yield, simply revenue over TTV, which is at the top end of the buy now, pay later sector and way above our largest competitor. Receiving fee income from merchants and consumers in Australia, particularly in our less contested specialized verticals, and also having higher margins in our sweet spot of 3 to 6 month plans, makes us reasonably immune to margin compression. For FY20, and Andrew will allude to this later, our EBITDA loss before significant items was 30.1 million, well in line with our expectations, as we continue to invest in our receivables book, in our tech, talent, in new products, merchant acquisition, and new markets for future growth. As we grow and scale our business, there's plenty of headroom for us to systematically reduce our cost base. To give you some examples, as we rapidly grow our receivables book, we will become eligible for warehouse financing structures for significantly lower rates than specialized debt funding, which will drive interest costs down. Second, the same applies for third-party costs, which will lower as our volumes and negotiation power increase. With our fully scalable technology, we can enter new payment partnerships and verticals with marginal incremental costs. And finally, as more of our customers become repeat customers, we have lower customer acquisition costs and require less external credit checks, and our credit losses reduce. So this continued operating leverage provides us with a clear path to mid to long-term profitability, keeping our revenue yield high and bringing costs down as we scale. Andrew will provide more detail on our financial metrics in his part. Let's move over to page 9 and the introduction of our 2 main products. On this page 9, you find our value proposition as a leading technical platform for differentiated payment and lending services at a glance. On the left, our strongly differentiated approach in buy now, pay later starts with our flexible platform to enable plan length from 2 to 24 months up to $20,000 in one simple customer journey and with no interest. Secondly, we strongly focus on specialized verticals like home, auto, health, where we are often the only provider and can make a true difference for the merchant and the consumer. These verticals, where we earn higher margins on our plans than in retail, account for around 45% of our business. Thirdly, we target a predominantly finance-savvy older demographic who use our product as a budgeting tool to manage their cash flow smartly, spreading payments over time in line with their income. On the right, and more recently with OpenPay for Business, we have built out our platform capabilities to deliver our payment service into a new, largely untapped profit pool in the multi-trillion-dollar B2B market. In February, we announced entering the B2B sector with an inaugural agreement with Australian retailer Woolworths. What started as a competitive tender, which we won against a credit card provider 2 years ago, has become a powerful software as a service SaaS portal, which will enable Woolworths to manage their business customers' accounts and payments seamlessly, including account applications, credit checks, approvals, and account management, all based on our tech platform. The agreement with Woolworths is for an initial 3-year term with an option to extend for a further 2 years. We are well on track to go live in the first half of FY21. Now over to page 12 and our response to the crisis. This page alludes to the way that we have managed the unprecedented challenge of COVID-19. We moved swiftly to implement decisive measures in response to this pandemic starting in mid-March. We provided vulnerable customers with financial hardship support. We temporarily reduced our employee expenses by 35% to preserve cash levels, adjusted plan settings, and tightened credit rules. We also strengthened our credit risk decisioning and fraud prevention technology and closely supported our essential service merchants. Since 1st of July, our team has returned to full-time hours and we are ready to fully capture the substantial growth opportunities ahead of us. Over to page 17, talking about the UK. In June 2019, we launched our Buy Now, Pay Smarter product in the UK, our first international market. We started with some selected merchants in online retail to test and refine our differentiated product in this highly sophisticated and innovative market. Since then, we have successfully signed and launched more than 24 retailers. In May, we launched very successfully with our first enterprise retailer, JD Sports. Across all our UK merchants, we have secured 187,000 active plans and 108,000 active customers in our first year, with a strong positive trend into FY21. We are also currently working through the process of an FCA credit authorization, which will make our offer even more flexible, and we are preparing for launch into other verticals in the UK over the next 12 to 18 months. Let's move over to page 18. We are proud to have many of Australia's and increasingly the UK's leading merchants under contract across all industries. Our trusted partnership with many of them has been proven with very successful joint marketing initiatives like in OpenMay, our month of promotions, and has resulted in extraordinary outcomes during the COVID-19 crisis, where we have worked together very closely to provide Australians with essential products and services like sanitations and mobile car servicing. On page 20, our customer base represents people who invest in their lifestyle in a responsible and mature way. From a demographic perspective, we attract customers across all age cohorts with a median age of 39 years, which is significantly older age than our competitors. Typically, these customers use our product to spend for their families and pets' health, their car's performance and safety, making their home a pleasant place, and other personal needs. FY20 has confirmed the trend of our customers using OpenPay more frequently, and at the same time, reducing the average transaction value and plan length to $272 and 3.7 months. The majority of our plans sit now in the 3 to 6 month bucket, which leads to a number of advantages. First, it clearly demonstrates our differentiation from our competitors. But second, it also comes with a favorable commercial profile, particularly in our high margin verticals in auto and health. Moving on to page 25. In FY20, we have delivered on our strategic promise, the extension of our verticals. In Q4, we conducted a soft launch into education and sport memberships on the back of some great early wins. Recently, we announced an exclusive 3-year partnership with MSL Solutions, which gives us access through their software to 400 golf clubs and their 135,000 golfers who will be able to use OpenPay to pay their membership fees, which can cause quite a bill shock, and spread their payments over time. We will see further deals coming through, which will inform a hard launch in these verticals in the first half of FY21. Please move to page 28. OpenPay for Business has been our major innovation in FY20, but not the only one. Amongst others, we have introduced a new data and advanced analytics infrastructure to enhance credit risk decisioning. This has enabled the targeted adaptation of credit rules in response to the challenges of COVID-19, keeping credit risk healthy and minimizing financial hardship. We also launched a new consumer app in March 2020, making it even quicker for customers to sign up and easier for them to manage their payment cards. A new release of our automated risk management ARM technology, also in March, significantly reduced fraud write-offs in Q4 FY20, and its positive impact has continued in FY21 to date. To conclude, before we pass on to Andrew, we have been extremely happy with the strong operational performance in FY21 and the progress we have made regarding our vision to change the way people pay for the better and along the dimensions of our growth strategy. We feel particularly encouraged by the excellent growth rates of our leading indicators in Australia and in the UK, and the positive ratings and feedback which we get from our customers, merchants and consumers alike. I will now hand over to our CFO, Andrew, who will discuss our financial position in more detail.
Thanks, Michael. Good morning, everyone. Today, I'm going to focus on key financial drivers. I'll give you an overview of our profit and loss, and then details around our credit performance and funding positions. If we move to financial highlights on page 31, the fiscal year 2020 has been a record year across all of our growth metrics. As indicated earlier by Michael, total transaction value is up 98.2% to 192.8 million. Our buy now, pay smarter income up 64% to 18 million, and our net receivables up 75% to 46.3 million. You can see the success of our growth strategy and the continued reinforcement of our diversified offerings approach, even given the uncertain times through COVID-19 pandemic. The early phase of our growth strategy is all about activating and expanding our customer base. As a result, we have increased our active customers by 141% in the current year, driven by our retail verticals in both Australia and the UK. As expected, our margin metrics of gross revenue yield and net transaction margin have compressed slightly, in line with the high growth strategy. The gross revenue yield of 9.3% remains very healthy and significantly above industry benchmarks, as is the net transaction margin, which is 2.5% for the period, down from 4.3% in FY19. Our customer engagement metrics, being the repeat customer base growing to 72%, and the number of customers with concurrent plans increasing to 45% in the second half, will both have positive impacts in reducing our customer acquisition costs and our credit losses, increasing our profitability in the mid to long term. Very pleased to show that, or to see that we're continuing our strong growth in the high velocity retail vertical, albeit with slightly lower margins. This growth was accelerated by part shifting to the OpenPay online channel, with more than 45% of our active plans for the year being online. We expect to continue to grow the retail vertical, as well as providing those customers with cross-pollination through to our higher margin specialist verticals in automotive, health, and home improvements. The expansion of the retail vertical has brought other financial benefits. Our average plan length shortening to 3.7 months over the year. This reduction in plan lengths has a positive impact on our ability to recycle cash, which will continue to lower our overall effective interest rates. We currently are turning over our receivables at about 4.2 times per year, up from about 3.1 times last year. Our net transaction loss for the period is up to 2.3% from 1.2% last year, reflecting the losses from bad debts from earlier in the year and targeted fraud as previously disclosed in the third quarter. In the fourth quarter, our net bad debts written off as a percentage of total transaction value reduced down to 2.9% compared to the 4.7% we recorded in the third quarter. This was all driven by the enhancements to our internal automated risk management system and the integration of additional third-party fraud enhancement tools released on our platform in March. We will discuss the funding position later in the presentation, but it's fair to say that with $151 million of cash and undrawn debt facilities, OpenPay is in a very strong position to continue the growth strategy over the current period. If we move to the financial performance on page 32, as highlighted earlier, the Buy Now Pay Smarter income increased by 64% to 18 million in the FY20 year. The revenue mix has shifted slightly, with more revenue being generated from consumer fees, which are up to 54% in FY20 versus 48% in the FY19 period. This is reflective of changes in the merchant mix, as well as growing number of active plans, which are up 229% for the year. From an operating expense perspective, we have delivered on the planned investment in our people, process and platforms, as outlined in the IPO, and is reflected by the increase in the employee benefits expense up to 18.1 million for the year, and the other expenses of 18.8 million, which represents the professional services fees, data and technology costs, increased sales and general costs, as well as higher administration costs resulting from being a listed entity. Our receivables impairment expense has increased to 4.1% of total transaction value for the year, up from 3.1% last year, partially driven by the bad debt write-offs discussed earlier, and partially driven by the increase in the expected credit loss provisions, including a conservative incremental overlay relating to the current COVID-19 conditions that we'll address in more detail later in the presentation. From a bottom line perspective, our overall EBITDA loss before significant items was 30.1 million, very much in line with management expectations and the investment strategy for the business. Our loss before tax and significant items of 36.5 million is in line with the expectation range that we provided earlier in the year of 35 to 40 million. On a credit performance, page 33, overall, the second half of the year has been very positive from a credit and a fraud performance perspective, especially given the uncertain conditions caused by COVID-19 pandemic. The continued focus on our credit decisioning capability has resulted in the reduction of our arrears as a percent of gross receivables down to 0.8%, a reduction of 40 basis points on FY19 and well below industry benchmarks. We're also very pleased with this result, particularly given the current uncertain conditions. As previously discussed, we've also seen net bad debts as a percentage of total transaction value reduced to 2.9% for the fourth quarter, and is currently less than 2% year to date in fiscal year 21. Even though our arrears have reduced to 0.8% in the period, we have taken a conservative approach and increased our provision for expected credit losses by including an additional 23% overlay in the calculation of the provision relating directly to COVID-19. The final provision is 2.1 million for the end of the year versus 1.3 million in FY19. From a cash and funding perspective on page 34, as mentioned earlier, we're well funded to support the continued growth strategies with 151 million of cash and undrawn facilities. During the year, we saw the cash outflows for the year of about 61 million, which included 30 million of net operational cash burn, driven by the investment in people, process and platforms over the year. 27 million relates directly to timing differences between the payments to merchants and the receipt of cash from consumers. This was offset by 19.5 million of drawdowns from our receivable funding providers. There was also approximately 3.7 million of investing cash flows, lease payments, and year-end foreign exchange impacts. During the year, as Michael alluded to, we capitalized on strong demand for our equity, driven by $26.2 million of pre-IPO funding, an oversubscribed $50 million initial public offering, and the subsequent $33.8 million of institutional placement in June 2020. This all results in us having 70.1 million of cash at hand at the end of the year. We've also expanded our available debt financing through new facilities and the extension of existing facilities. In total, we have facilities of $75 million in Australia, with 45 million undrawn, and 25 million pound in the UK, with 20 million undrawn as at 30 June 2020. Both the 255 facility and the GGC UK facility have potential to extend to 100 million and 60 million pound respectively, based on continued performance of the portfolio and some other conditions precedents. Overall, we are very pleased with the progress that we've made in FY20, both across the top line and the bottom line, as well as in regards to our strong cash and funding position. With that, I will hand you back to Michael. Sorry, Michael, you're still on mute.
Good. Can you hear me again?
We've got you.
Good. Excellent. Good. Many thanks, Andrew. So as you have heard, we have achieved strong growth in the past year across all dimensions of our business. This provides us with a very healthy basis for further accelerated growth in FY21. Despite this profoundly strange and difficult year in the world, OpenPay's outlook is promising. On a more macro level, Buy Now Pay Later has proven to be an attractive way for consumers to pay, with significant adoption in all large retail and consumer markets around the globe. Demand for what is a relatively new financial product has grown at exponential rates and continues to increase as new markets, products, and geographies open up. Even through the challenging times of economic lockdowns, Buy Now Pay Later has proven its potential to become a preferred way for people to pay at a global scale. At OpenPay, as I said before, we are just only getting started. In FY20, we have ticked many boxes of our growth strategy, but we are still at the very beginning of a long-term journey. As we continue to deliver consistently against our strategic growth drivers, we feel extremely well positioned to take a significant share of this huge emerging market opportunity, adding value to our customers and our shareholders. Turning to page 38 and the trading update of July 2020, shows us that our start into FY21 has been excellent, with continued strong growth across all leading indicators, with record year-on-year uplifts, particularly in active plans, active customers, and TTV. We also have a very healthy pipeline for merchant acquisitions in both markets and some ongoing integrations with large retailers, which will bring more plans and customers in the near future. This brings me to my last page of the presentation, page 39. In addition to our existing growth areas, FY21 will see a heightened focus on strategic, hopefully exclusive partnerships in Australia and the UK for Buy Now Pay Later and B2B, entering merchant agreements, for example, with enterprise retailers and tech platform providers to scale both products. We will also strongly focus on extending our footprint in the UK into our specialized verticals, and will continue to explore a merchant-led expansion out of the UK into compelling markets in Europe. To further enrich and extend the capabilities of our technical platform, we will focus in FY21 on integrations, automation, and self-service of merchant onboarding and activation, on the continuous improvement of customer experience and conversion, and on data analytics to inform credit and fraud decisioning and reporting. As a fintech company, the continuous improvement of our core technical assets to drive sustainable growth is key to our strategy and the foundation for our ambition to become a global provider of leading payment services for people and businesses. I want to take the opportunity to thank the OpenPay team for the relentless effort on providing our customers with the best possible service, and our merchants, business partners, and customers for their loyalty and belief in our responsible buy now, pay later approach. Also, thank you for your great support, Andrew, as this is your last investor call with OpenPay before our new CFO, Jussi Nunes, joins us next week. Finally, I want to thank all of you in this call for your trust and support during this eventful and successful year. We are very much looking forward to another 12 months of delighting our customers and delivering sustainable value to our shareholders. We will keep you updated on our progress. Thank you. With this, we will now enter the Q&A part of this call with Jane to moderate, and over to you, Jane. Thank you.
Thank you, Michael, and thanks, Andrew. I'd like to now open up the session to questions. As a reminder, if you'd like to ask a question, please type your question in using the Q&A function, which is in the Zoom ribbon at the bottom of your screen. We've earmarked about 15 minutes for this Q&A session. So if we don't get through everything today, please feel free to email through to investors@openpay.com.au and we can deal with any other questions offline. So we might start with one from Danny Eunice of Shaw. Thank you very much, Danny, for sending through some questions. So for you, perhaps, Michael, it appears that the UK is going gangbusters. Is the expectation that a move into Europe in 2021 is possible sooner rather than later?
Yeah, thanks, Danny, for that question. You're right. The UK is going extremely well from a uptake perspective of our differentiated product. And just to remind everyone, there's still a lot of ground to gain in the UK, us planning to enter other verticals over time. But you're right, it's clearly on our strategic roadmap to enter the UK market as well. And we look at this probably from a merchant-led perspective to follow some of these large enterprise merchants into some promising European markets over the next 1 to 2 years.
Thank you. Okay, next question relates to the verticals. So you've recently launched into memberships and education as 2 new verticals. Which other verticals do you plan to move into as part of your growth strategy?
Again, there's still a lot of space to win in our existing verticals, auto, health, and home, and in the 2 new ones. We have soft launched recently. We have now some really big wins happening probably very soon, which will inform our hard launch in the course of this financial year. And as further plans, with the flexibility of our product, we can accommodate upcoming opportunities driven also by large merchants in Australia to start with in relatively short period of time. And this will inform of our continued proliferation into new verticals. But I think so far we are very happy with the performance of our existing 3 and want to extend further into the 2 with a hard launch to come soon.
Thank you. A question on competition. So is there enough space for a company the size of OpenPay to compete in the BNPL sector given the size of your competitors?
I definitely think so. And if you look at the growth rates, which we have seen now over the last periods of time, particularly around active plans, more than 230%, active customers, 140%, there is a lot of room to win. From my perspective, it's not really gaining market share, one buy now, pay later against the other. We see still a lot of purchase value coming through, which is not through buy now, pay later yet, particularly in store, but also very strongly in in online, even in retail. And if I consider where we are very often the only provider, or maybe one of two, in home, auto and health, and now these emerging other verticals, there's so much space for differentiated providers to win. I'm not worried. And I think, and this has also shown the example now recently in the UK market, where we see fierce competition in retail. With our differentiated longer term plan, we can really make a difference, even in such highly contested space, and really grow at scale. And I think this is very, very encouraging, and will give us a good runway to further grow and scale the business.
Okay, a question that is is perhaps related. Is growth through acquisition part of your strategy?
Yeah, so far I think we have demonstrated strong growth organically, which shows the underlying strength of our business model. But I would never exclude if and when opportunities come up over time for new spaces geographically, new products, maybe tech partnerships, I would not exclude acquisitions.
Okay, so perhaps a question for Andrew. How do you see impact from margin compression coming into effect over time?
So you're certainly going to see ebbs and flows as you go through different sort of market segments. But I think that we can see that with our current revenue, gross revenue yield at 9.3%, we are a market leader. We're able to maintain that quite significantly. And I think that we've got significant operating leverage or in our existing cost base as we continue to grow. As our repeat customers continue to grow beyond that 70% mark, we're going to have lower costs from acquisitions, we're going to have lower credit losses, and we're going to continue to be able to improve our margins going forward into that sort of next phase of the growth strategy.
Thank you. And since we're talking about margins, this is a question on expenses. So employee expenses more than doubled from 7 million to 18 million. Is this enough to cater for the continuing and significant growth expected in the business from the underlying BNPL product moving into new vertical and B2B, or will it require an additional step up in employee costs in FY21?
Yep, thank you. FY20 saw a significant investment in our growth in our people, platforms, and our process. So we definitely had a large step up in the FY20 platform. What we're looking to do is to take advantage of that from a scale perspective. So as we grow the business, we're looking to again have more operational leverage from maintaining a strong or maintaining the cost base. And not growing as fast as what you see the growth within the revenue side.
Thank you. This is back to geographies, and similar questions come up a couple of times. So is there a plan to enter the Asian market over the next few years?
Again, definitely our ambition is to become an international, if not a global provider of this buy now, pay later in the way how we interpret it, with longer term plans, with a responsible approach, and also obviously then supported by what we can do on the B2B side of the business. And we see now increasingly markets opening up for buy now, pay later. I think the proliferation increases and accelerates now, and we look at markets and opportunities as they come up, and Asia would also not be excluded from that perspective.
Can you talk about the future pipeline of additional merchants in the new verticals channel? Are there ongoing discussions with other big merchants in the education and memberships channels? And are you looking at other channels as well? Sorry, I think you've already answered the latter bit.
Yeah, I can confirm there is more to announce over the next period of time in both verticals. We are working on significant partnerships, which will give us also in these particular verticals some more scale. MSL Solutions has been a great example in the sports membership. One contract, one signature, but access to 400 golf clubs and their 135,000 golfers for membership fees exclusively provided by OpenPay. I think these are the big deals which will inform in the near future a hard launch into these two verticals. And again, there's other areas which you could think of where our particularly differentiated product of longer term and flexibility makes a lot of sense, and we investigate further verticals, but further down the track.
Thank you. So there's been a lot of press about some of your larger competitors charging high merchant fees in Australia. Have you seen some pushback on this front from retailers you are currently in negotiation in, or is it still business as usual?
If you compare to our competition, particularly on the 2-month end, on the shorter end of plans in retail, we offer less expensively to merchants because we also, from 3 months, charge consumers a fee. And I think from that perspective, I think we got it really right to deliver value into the merchants, but also in the consumers, and getting a respective fair, transparent fee from both sides. We haven't seen margin compressions on the short end in retail yet, as we are operating to lower merchant fees than our competitors, and already from the 3 month into the 6 month, which probably informs the sweet spot of plan range from plan duration and plan value perspective. We are able to maintain our margins in line with the value, the incremental ATV uplift, and increased conversion rates which we provide merchants with, and also giving consumers the opportunity to spread payments over a longer period of time for things which are really important for them. So I think we are, from that perspective, also confirmed by our gross revenue yield in a healthy space.
Okay, so Afterpay and Sezzle both have loyalty programs. Loyalty seems the final frontier for BNPL. What is OpenPay doing in regard to offering a loyalty program?
We don't have a direct loyalty program yet. Nevertheless, our customers come back and become loyal customers as they really appreciate to use us across the different areas of lifestyle, which we mentioned before, around their home, their car, the health of themselves and their families and their pets and everyday purchases. So for us, this is not yet on the strategic agenda, but we are obviously doing a lot in direct marketing to make customers aware of opportunities with us, which we kind of facilitate in partnership with different merchants. And we cross-pollinate them, as we call it, into other verticals to give them the opportunity to really benefit from our flexible plans, not only in the one area where they came onto our platform, but really across the broader range of opportunities which we offer them.
Okay, thank you. We might move over to B2B. So question here, just curious about more information on how the B2B product works.
So technically, to start with, before we talk about the commercial terms and conditions, technically it's a software as a service platform. What we do, or what Woolworth do with us for the whole process of them managing the accounts and payments with their business customers, they rely on our software as a service, and they call through APIs the respective service, customer merchant onboarding, ID verification, fraud credit check, setting up the payment, the invoice terms, and making the back-end reconciliations and bookings through our platform. This is what we enable in a smooth digital way, which is really unique to the market. From a commercial perspective, this is the typical software as a service commercial model. I can't go into too much details, but typically what you see is a usage based fee, which we get as we onboard business customers and as we see payment transactions coming through.
Thank you. Okay, I think we might make this the last question because we're coming up to time, but this is one that I know has been asked recently in other channels. So in simple words, when can we expect OpenPay to start making a profit? Thank you for such a great company. I have great faith in OpenPay.
Thank you very much for that positive feedback. Currently we are focusing strategically very much on growth. This is now the time to grow the business. How we have set up the business model, and again, making that point of our very, very strong market leading, if you like, if you compare to competitors, gross revenue yield, which is the revenue which we get from TTV, we are in a very, very healthy spot from the outset to make this a profitable business in the mid to long term. We have significant leverage operationally on these different cost items to reduce them over time. If you think of funding costs, for instance, we have now a receivables book of $46 million. I think as we get north of $150 million, we will become eligible for securitization and warehouse financing facilities from banks, which come to significantly lower cost, as we have seen from our competitors. So there's a lot of opportunity from a very high gross revenue yield to start with, to commercialize over time and make this a profitable company. I will not provide guidance on when this will be, but I expect for sure this to happen in the mid to long term.
Excellent. Okay. Well, thank you very much, Michael and Andrew. I might hand back to you now, Michael, for closing remarks.
Thank you very much, Jane. And again, we have seen an extremely positive proliferation of our responsible approach in buy now, pay later over the recent years, with a very, very successful FY20. We had a very, very promising start into FY21 with promising, in parts, record growth in July, and we see a continued positive trend in August as well. And we are very much looking forward to keeping you updated on our continued progress to deliver against our strategy and create long-term shareholder value. And with this, thank you very much for your support, and we talk soon again. Thank you very much.
Thank you.